Hello and welcome to our channel. For those of you who are new to this channel, my name's Charles Delastic. I'm the Managing Director of Blue Bond Tax Planning. We've been helping clients for more than 18 years to avoid and eliminate inheritance tax. Now today's video is all about estate planning and the importance of that particular aspect of the planning, which in many cases actually turns out to be more important than inheritance tax. If you like the video, please give us a like in the section below and hopefully you'll find it very useful and helpful. Thanks, and cue the intro. Okay, so as I explained, today's video is all about why estate planning could be more important than inheritance tax planning. So let's get started. So firstly, what exactly is estate planning? So estate planning is all about the aspect of making sure that your wills and trusts are tied up to achieve the results that you want to achieve when you die. So that's really around the right people getting the right money at the right time. And more importantly, it's about bloodline protection. Most people, when they die, want their money to go on to their children and then on to their grandchildren and not to come out of the family bloodline. And that's what estate planning is all about. So we'll see what the issues are around that. So in this area, there are generally 5 problems, some of which you might think of and others which may not be immediately obvious. So let's go through those. So the first problem, which you might well have thought of, is divorce. So in the event of you leaving your money to your children, and then maybe well after you've died, your children then get divorced, what's the impact on the money that you've left your children? So let's say you leave each of your children $1 million, right? And we've saved you the inheritance tax. They get divorced. What's the issue? Well, 50% of that money could walk, right? So that's more than inheritance tax at 40%, because with inheritance tax you get allowances up to $1 million if you're a married couple, and then there's a tax of 40% on the excess. Here, literally 50% of the money could walk in a divorce case. So it's really important to protect the money against that scenario happening, especially when we think that the divorce rate in the UK is what, 50% plus these days? So not a small aspect. So the next issue is bankruptcy. Okay, so more and more people are starting their own businesses. Now, if you leave your money to your daughter and her husband starts a new business, or vice versa, then their assets are joint, right? Now, if they're not careful and they go bankrupt, 80% of small businesses actually go broke in the first 5 years, right? It's risky, but people do it. And if they go bankrupt, all of the assets you leave them without careful protection could walk to their creditors. So how do you protect that? The third issue you might not really have thought of. So this is remarriage. So inevitably, let's say you leave money to your son or your daughter, it doesn't matter. They are married. They then die before their spouse. Then your ex-son or daughter-in-law gets remarried to somebody else. But that new person into the family, this may be well after you've died, right? Haven't raised your grandchildren. Well, there's a fair possibility that if we leave everything to the spouse and then they leave it on to their new spouse, that the grandchildren may get cut out completely out of the money that you left, whereas you probably want to make sure that it goes to your children and then on to your grandchildren, right? So remarriage is an issue. This isn't something, inheriting early, this isn't something that most people think of, but pretty much everybody who's got young children, if that couple were to die, then at age 18, their children would inherit everything. Now, if you've left a fair amount of money, if your children have got insurance and everything else in place, and they leave a fair amount of money, you could end up with an 18-year-old inheriting a couple of £1 million. Well, probably not the most sensible strategy, because they're too young and aren't emotionally mature enough to deal with that kind of money, right? So inheriting too early is an issue. Last but not least, there's what I call the 64% tax. So who pays 64% tax? That's extraordinary, right? Okay, if you think about it, if you don't deal completely properly with your inheritance tax problem and you pay 40% tax, and then the money passes to your children, who also then have an inheritance tax problem, by the time it gets to your grandchildren, second generation, they will pay 40% on the money left from the original 40%. So 40% of 40% is a 64% tax rate, which I'm sure you agree is not what you would want your grandchildren to have to pay in that event. So again, how do you protect against those problems there? So you will be glad to know there is a solution. We wouldn't be doing the video without it, right? Okay, so what are the various solutions? So first of all, discretionary trusts. Right, so we'll explain in other videos what discretionary trusts are, how they work, but in an ideal world, what you want to do is to set up a lifetime trust. Again, in another video, we'll show you the differences, but generally speaking, these are trusts that are set up during in lifetime, as opposed to in your will, and then it takes effect on death. Because if you set it up in lifetime, you could set up one trust on Monday and another trust up on Tuesday, right? Because you're still alive. And effectively more than one trust can be set up. But when you die, all the trusts, if it's within your will, are set up on the same day, because you've only died on that same day, right? So effectively, there are benefits to setting up more than one trust, and that's why we always work with lifetime trust arrangements. Okay. Can't read that very well, but we're saying here a will plus trust. So it's a will plus some discretionary trusts. And who do you appoint as the trustee? So in other videos we explain the differences there. But generally speaking, the people who control the assets are the settlers. That's you during your lifetime, if you set up the trusts. Your adult children should also be trustees, because effectively that saves costs, because you're not paying professional trustees. You could, but your adult children should be able to do it. And lastly, we would generally suggest you appoint one other person who's not a beneficiary of the trust to act as a trustee. This is just in case your adult children disagree on how the trust should be dealt with and managed, then you've got a person there acting as a referee, right? So that's why we would normally suggest one other person. Okay, so how does all this work in estate planning, and how does this solution work to avoid those 5 problems of divorce, bankruptcy, remarriage, inheriting too early, and 64% tax? So if you need to, take a screenshot of that, and then we're going to go on to the explanation in just a minute. So how does the solution of setting up lifetime trusts and wills together help protect the assets against the 5 problems that we were talking about? So in a normal case, without having lifetime trusts and without having wills written in conjunction with those trusts, what would happen? You write everything to your will. I want to leave everything to my children in equal measures. So this is the Jones family, Steve and Anne. They've got 3 children, John, Dave and Jane, and they've got some grandchildren down there. So what Steve and Anne would want to do is they would want to pass their assets in equal measures to John, Dave and Jane. And then if John dies, then it passes on to his children, so it goes down the family bloodline, and that's what they would hope to happen. So effectively, in a normal circumstance, they would both write a will, and let's say Steve dies first, he would leave all of his assets to Anne, and then when she dies, she leaves everything to the 3 children via her will in equal portions, which is the normal scenario, right? Now, effectively, what then happens is that all the assets are owned by John and his wife here. Let's call her Mary. and Dave and his wife, let's call her Anne as well, with an E, and then Jane and her husband, and let's just call him Mick. So there we've got family. Anne's died, leaving money to her 3 children. That's what she would want to happen, and she's done that via a normal mechanism, which is her will, right? Okay, so effectively the problems that would occur is that obviously if John and Mary got divorced in the first place, well, let's just say we ended up leaving, I don't know, we'd done some a bit of planning or whatever, and we'd end up leaving the children 800k each. Right? So effectively that would be, they would pay some inheritance tax if they hadn't done it, but that's the scenario. Now, if John dies first, then the 800k now belongs to Mary, right? Now she goes off and marries her golf instructor. Let's call him Andy. Okay, so Andy and Mary are now remarried, but then because Andy's quite fit, he outlives Mary, but she's got the 800k. When she dies, it goes across to Andy. And Andrew decides, well, don't really know the grandchildren very much, don't get on with them frankly, he didn't raise them, he decides to cut them out of the £800,000. Well, that isn't what Steve and Anne would want, right? So that's an issue in the first place. So that's the effectively remarriage issue. That's the divorce issue and the remarriage issue if that was to happen. So in the event of divorce, then Mary would just walk off with the money, obviously. So here, if Dave and Anne, one of them was, say Dave got bankrupt, then the money would go on to creditors and there would be an issue. If we paid tax here, we paid tax at 40% here. By the time the grandchildren paid it, it would be another 40%. So that's your 64% tax. So those are generally the issues. So what we would do is we would look to set up a will plus 3 additional trusts. So that when Steve died, his money would go into his trust, and then Anne's trust over here wouldn't necessarily get utilised. And a part of the value of the house goes in there, right? So 325,000. And then when Anne dies, effectively, because the beneficiaries of the 3 kids here, they each get the money into those 3 trusts. So what happens then, and how does it work? So these trusts then lend. So they lend the money to John, Dave and Jane. They still got the money. They've still got the 800,000. There's no issues. And they lend that money interest free, but it's recallable by the trustees on demand. Who are the trustees? John, Dave and Jane. So they are the beneficiaries of these trusts and the trustees. So they carry out both duties. So if John's going to get divorced, say to Mary, he says to Dave and Jane, oh look, I'm getting divorced from Mary. They go, sorry to hear that. It's our legal responsibility to protect the money in the trust. So this isn't just a whim, it's a legal responsibility to protect the money, because all the beneficiaries, John, Dave and Jane, plus the grandchildren, are all beneficiaries of these trusts, right? Therefore, if it's their legal responsibility, that loan is then recalled back in to John's trust. Therefore, the remaining assets, when John and Mary get divorced, what happens? The 800,000 doesn't get passed out. Why doesn't it get passed out? Because it never belonged to John. It was only ever a loan. In the same way as if John and Mary had a house and the house was worth 600,000 and they had a £200,000 mortgage, well, they couldn't take 300,000 each, could they? They would have to pay the mortgage back first, the 200, and then they've still got the money that's left, and they would split the money that's left. And it's exactly the same. Because the trust has made it's legally drawn up at the time of Steve and Anne's death, and effectively that protects the money into the trust. So the day after John's divorce is settled, Dave and Jane say to him, John, do you need that £800,000 back? Yes, please, I do. And they give it back to him. They give it back to him as a loan. Exactly the same. So it's the loan mechanism that affects it. Now, in the scenario of remarriage, where Mary goes off and they didn't get divorced, Mary goes off and marries Andy, well, Mary doesn't get the money. It belongs to John. Now, John may have set up some additional trustees to maybe give Mary some income, right, and make sure she's okay. Dave and Jane may well look after Mary in that event, but the moment she gets married, they can either recall the money, or else they can say, well, you never had the money in the first place, so therefore she cannot leave it to Andy, even if she makes a mistake. Therefore, eventually, the money goes down to the grandchildren down here. So that's the other benefit in the event of remarriage and divorce. In the event of bankruptcy, well, the creditors can't get the money. Why can't they get the money? It doesn't belong to Dave, does it? It doesn't belong to Dave and Anne. It belongs to the trust. It's always belonged to the trust because there's a legal agreement to say so. And therefore, the creditors can't touch the money in the event of bankruptcy. If Dave and Anne die young and their children are going to inherit it at 18, well, will they inherit it? Well, they might well inherit Dave and Anne's money, but they won't inherit Steve and Anne's money up here because it belonged to the trust. And therefore, the remaining trustees, which are Jane and John here, would make sure that the grandchildren didn't get the money too early and didn't fritter it away. In other words, it's protected because the loan agreement works in all those scenarios. And then in the final scenario, how does it avoid the 40% tax and the 40% tax adding up to 64%? Well, it can't avoid the first 40% because even when the money went into the trust, if it exceeds the allowances, the tax is going to be paid. This planning is not for inheritance tax planning. There is, interesting, a mechanism around here which does save some inheritance tax, which effectively, because the value in the trust grows faster, because the value of a house will grow faster generally than the allowance for inheritance tax. So that 325 would grow faster, and there was a gap between Steve and Anne dying, and the growth in that exceeds the rate of which the allowance grows. You can see there's a saving. Also, inevitably, that trust plus Anne own the house when Anne dies. Now, because it's two separate legal entities, that's interesting, because it depends on the circumstances, but you can get a discount on Anne's share of the house of between 10 and 15%. If that house is worth $1 million, that's a fair amount of money saved, right? But the purpose of this planning is not inheritance tax. It's just an additional benefit here. But the main point here is that in the event of divorce, it protects the money. In the event of remarriage, it protects the money. In the event of bankruptcy, it protects the money. In the event of the 40% plus the 40% adding to the 64, it protects the money. And last but not least, in the event of the children inheriting the money too early, it also protects it because the main point is that they never got the 800,000 each in the first place as a direct gift, as they would have done if we'd not set up the planning, right? If a normal will would have gifted that money directly to those 3 children, and then the problem occurs is because they own it directly. Here, because we've set up the trusts during lifetime, we can set up separate trusts for each of them. That works. All we do is put £10 into each one of those trusts, and that works to set up the trust in the first place. And this mechanism can save thousands of pounds for a family, because let's face it, with 3 children and a divorce rate of 50%, pretty certain one of them is going to get divorced, right? Not absolutely certain, but pretty certain. Okay, so is estate planning more important than inheritance tax? Depends, but you can see it is effective, it is worthwhile, and because divorce can affect 50%, creditors can affect 100% of the money that you leave, it's important that you think about the estate planning as part of dealing with stuff as well as dealing with the inheritance tax. Okay, hopefully you found that useful. If you found that video useful, please give us a like below. If you're interested in inheritance tax, please subscribe to our channel. You will find down below in the links a free link to an ebook around inheritance tax, and there's also a much more comprehensive guide to inheritance tax on our website, which you can download. But thank you very much for listening, and goodbye for now. Thank you.